Good afternoon. This is Jeannie, and it's been a really choppy day in the U.S. markets. And I wanted to drop a quick video to touch on some of the jargon that you all might be seeing flying around the news. Now, we are experiencing some sharp declines. Many of us recognize two primary triggers for those. The first being the uncertainty around the coronavirus and how it could potentially impact the U.S. economy. The second one you may not be as familiar with, and this came last week as a surprise to many. Now, it has to do with the price of crude oil. And OPEC is an organization of about 14 different countries that export oil. And the whole goal of OPEC is to actually manage the supply and production of oil in an attempt to manage potentially the price of oil. What we have been seeing lately is a sharp decline in the price of oil, particularly recently as fears over the coronavirus have curbed travel. And what was supposed to happen last Thursday, there was a proposal through OPEC to actually reduce production even more to kind of help support the price of oil. And it surprised everybody when that proposal didn't pass, thereby creating more uncertainty. Now, many of us are sitting there thinking, is it a drop in oil prices good? And for us in our day-to-day lives, when we go to the gas station, when we order goods online, when we're running our company, yeah, generally speaking, we like to see lower oil prices. But what I think many people are missing is that production of oil and exporting oil has actually really bloomed in the US. In fact, it's doubled in the past decade. And even for a brief moment last year, the U.S. was actually a greater exporter of oil than Saudi Arabia. So we're talking about oil prices having a pretty significant impact on the American economy just because we are now such a large producer of oil. So the markets did not like the idea that oil prices fell so sharply, and they definitely didn't like the idea that we didn't come to an agreement on how to handle it. Now, it doesn't mean that OPEC won't agree to something in the future, but those were kind of the two things that sparked the correction. Now, what you're seeing in the news are references to circuit breakers. When the New York Stock Exchange experiences significant declines in value, they have built-in circuit breakers or processes that are actually designed to halt trading for a brief minute, give everybody a chance to catch their breath, and think about things around instead of just continuing into this, I'm going to say, mass hysteria of a downward spiral. What we saw today was the first circuit breaker got tripped. Once the S&P 500 fell 7% from the prior business day close, there was a mandatory 15-minute halt in trading to kind of let everybody reassess the situation. There's two more levels. Now, as of filming this video, the market is down about 7%. If it hits 13%, you will see another circuit breaker, another 15-minute hold on trading. It actually has to be down 20% from the prior business day's close in order for trading to cease for the entire day. Now, these circuit breakers have been around a long time. They were tripped back in the 1980s when we had days like this. Just remember, we are not expected to be day traders in our retirement accounts. These are our long-term investments, and you should always be reevaluating the risk that you're taking in your account. But during times of extreme market volatility, we don't want to make emotional decisions. What I'm hoping this video does is explain some of the jargon that's flying around, maybe give you a greater awareness of what is happening in the markets and on the world economic scale, but certainly not meant to trigger an emotional response from you, right? Just to provide some information and comfort. I will keep you guys updated as more information comes out, and I hope you have a wonderful day, and hopefully we'll see some levelization in those markets. We'll talk to you soon.